Hey guys, Toby Mathis here. And the question we get a lot is the tax treatment of stocks and option trading. So, the first thing to remember whenever you're involved in the purchase and sale of anything is that there's more than likely going to be a tax implication upon the sale of that asset. And that's no different than with stocks or options, bonds for that matter. If you are buying stock, it is considered a capital asset. So when you purchase it, you start something called a holding period. So if I buy shares of ABC Inc. on January 1st, that starts its holding period. If the market was open on January 1st, I should probably be more clear. How about we purchase it on December 31st, assuming the market's open that day. So the holding periods are 1 year or less, or 1 year or more than 1 year. So 1 year or less means I hold that stock for an entire year and I sell it on December 31st the following year. That would still be short term because it's 1 year or less. If I wait until January of the following year and I manage to get it just a day over the 365 days, then I would be long term capital gains. So the thing you have to remember is 1 year or less, you're short term. More than 1 year, you're long term. And there's a few little exceptions on different things, but I'm going to say as a general rule, that's the easiest thing to remember. Short term capital gains are 1 year or less, and they are taxed at your ordinary bracket. I'm just going to assume everybody is buying it for their own accounts. This is not the same thing for IRAs, 401ks, because they're tax exempt. But for you as an individual, or you through an LLC that's taxed as a disregarded entity or a partnership, if it's flowing onto your return, it's going to be taxed as capital gains. If it's 1 year or less, it's short term and it flows into your ordinary tax bracket, just like you made money at anything else. It is not subject to Social Security taxes, but it is subject to federal taxes and quite often state taxes at your ordinary rate. So if you're in the 37% tax bracket and you hold a company, let's say I buy ABC and I sell it 6 months later, those gains are going to be taxed at my 37% tax bracket. Now, here's an exception. An exception is if I'm doing futures contracts, in which case futures are always taxed 40% short term capital gains, 60% long term. So 40% would flow into the 37, and then the rest of it would be long-term capital gains. And the way it works is if you hold something more than a year, or if you're doing futures, the portion that is long-term capital gains, if I hold it longer than a year, I am now into long-term capital gains. It is taxed at either 0, 15, or 20%, depending on your taxable income that you have. So if you are in the 37% tax bracket, I can safely assume that you're going to be in the highest category for long term capital gains, which is 20%. So if I buy ABC on December 31st of, let's say, 2021, and I sell it at the end of January, not of not 2022, but of the following year. So I held it more than a year. So I'd be in 2023. Then I'm in long-term capital gains. I'm going to be taxed at 0, 15, or 20%, depending on my income. And it's basically like this. Like this year, I'm sitting here in 2021. You're right around $80,000 married filing jointly. If you're beneath that, if the gain is underneath that category, you're in 0%. So if I make $50,000 a year after all my standard deductions and everything, so I have taxable income of 50,000, and I have $10,000 of long-term capital gains, it'll be taxed at 0%. That's why people love the stock market, getting those long-term capital gains, and they're fantastic. Short-term capital gains, flip it around, maybe not so fantastic because it depends on my tax bracket. I still wouldn't get beat up too bad. I'd probably be looking at 22% tax bracket or something around there. So it's not horrible, even on the short-term side if I don't make too much money. The problem is if you are making good money and you also have stock gains, then all of a sudden it starts creeping up. And just to give you an idea, is if you're somebody who is making six, $700,000 a year and you have long-term capital gains, it's 20% federal tax. You also have a net investment income tax of 3.8, plus you have your state. If you're in a state like California where it's 13%, well, now you have to add all those things up and you're what in 36, 37% tax bracket again. And then there's talks right now as I'm sitting here, the Biden administration has not come out yet on long-term capital gains, but they're talking about bumping it up to 39.6% for people who make over $1 million. So all that comes in. But what I want to stress is that these are capital assets. So when you sell a capital asset in a year or less, you're going to be at short-term capital gains. When you're a year and above, it's long-term capital gains. Now we go into the realm of selling options or buying options. I'm just going to focus in on the sale of options because buying options, we're not so worried about. I'm purchasing. That's not going to be taxable. What's going to be I will say this, the option period, whether I'm selling and receiving money or whether I'm buying, I have a holding period now, but I have no taxable event there. So even when I bought it, it's not a taxable event until I either sell it or it expires or I'm assigned shares. So if I am selling calls, for example, I sell an option. So let's say I own ABC at $10 and I sell somebody the right to make me buy it, that I sell somebody the right to buy it at $11. So I'll just walk you through this. Because it's in or out of the money, meaning that it's more, I'm not deep in the money. I'm selling something more than what that company's worth. It does not affect my holding period of the underlying stock. So if I buy ABC, selling covered calls in and of itself will not destroy me or make me toll my holding period or anything like that. You don't have to worry about that. Some of you guys are like, huh? And I'm like, just don't worry about it. If I buy it at $10 and I sell somebody a call to buy it at $11, and let's say I give them 6 months to purchase it and they give me $1, I now have the $10 company and I have another dollar. I do not have to pay tax on that dollar yet. That is not a taxable transaction. That $1 that I received becomes taxable when I either buy back the option, it expires, or the stock is assigned. So let's say the stock goes up to $13 and I have that $1 I've received for selling the option. The individual who purchased the option exercises it, so they have the right to buy it at $11. So I get $11. So I bought it for 10. I'm getting 11, so I get $1 of gain, and I have another dollar of the option income. And I'm going to look at the holding period of the underlying stock to determine what that taxable amount is. I've received $2 more than what I paid for it. And we're going to look at the holding period. If the holding period is more than a year, that should be treated as long-term capital gains. If the holding period is less than a year or a year less, it's going to be short-term capital gains, and that's going to dictate how it flows onto my return. So I know this stuff gets a little bit muddy, and especially if you're doing straddles, there's even different rules. But I'm just trying to give you the general rule, and then we figure out what you are doing to determine whether there's anything in particular you need to be aware of. So, like if you're doing Forex, that could be ordinary income 100%. If you're doing 988 elections, it could be ordinary loss, which we'll get into here in a second. If you're doing futures, if you're doing 1256 contracts, etc., you could be looking at 60% long term, 40% short term, no matter how long you hold it. Like that's just one of those weird little things. You could hold it for 2 weeks and you still have some long term gain. Dividends, qualified dividends from American companies, they're treated as long term capital gains. They're treated at those rates. And so you start seeing, hey, wait a second, there's some pretty good stuff here. If I hold stock for over a year, if I receive dividends, if I write out of the money covered calls, those are all tax advantage. It's like a big start. Ding, you're being You're hit with the magic wand being told these are great tax treatments right there. Now, let's get into the stuff. Capital losses offset capital gains. If you have more capital losses than you have capital gains, you can use $3,000 a year against your ordinary income. And any that you are not able to use, you just carry forward into future years. So, example, I make $10,000 selling stocks, but I have a big loser that costs me $20,000. So I have $10,000 of gain, $20,000 of loss. The 20,000, it doesn't matter whether it's long term, short term, that capital gain is going to go wipe out, or that capital gain is going to be wiped out with my losses, whether it's short term or long term. So I'll use up $10,000 of my loss, knock out all of my gains. So I have zero tax. And now I have an extra $10,000 of capital losses. I can use 3,000 of that to offset my other income, like W-2 income, business income, things like that. I can wipe out $3,000. So I'll get to take $3,000 against, let's say I have a job in my W-2 income. So I'd wipe that out and I'd carry $7,000 forward. So I had 20,000 a loss, 10,000 a gain, wipe that out. Now I'm to 10. I take 3, apply it to my other income. I'm now left over with 7 that I carry into the following year. Let's assume that I had $7,000 of gain in the following year. I'd use the entire $7,000 of loss and I'd pay zero tax on any of that gain. That's how the losses work. But you have to understand that you can't just take capital losses and use them against anything. You have to use them against capital gains first and then other sources of income. I know that this stuff, some of you guys are going to go back and watch this a couple more times. Get a pen out and just kind of write it down and it'll start making sense. Trust me, there's people that have been doing this for decades. They get it. It's just become second nature once you start doing it. But the first time you hear it, the first few times, sometimes it's a little bit muddy. But then you start realizing, wait a second, the question that most people ask is it long term or short term? If I get called out, is it going to have an adverse tax consequence to me? If I'm selling covered calls, not a bad thing. I could actually roll out of a covered call. The time that the stock becomes or the option becomes taxable is not when I write it, not when I buy it, but when it expires. So either it expires or I sell it, buy it back, one of those, or it gets assigned. It's when it's closed out that's when the taxable event is. Just like with stocks. I buy $100,000 of stock, that's not a taxable event. I buy a bunch of Microsoft, not a taxable event. When I sell Microsoft, taxable event, and it's going to depend on how much I paid for it as my basis. You'll also see that your basis will get adjusted. If I'm selling, for example, if I sell a call or I buy a call, that's even a better example. Let's say that you're on the other side of the transaction I talked about earlier, where you have a $10 stock that somebody paid, you sell at $11 option, it goes up to $13, right? So I'm the new buyer. So I bought it at $11, even though it's $13, but I paid $1 for that option. That dollar plus the stock price, what I paid, becomes my basis. So in the real world, I bought an option for $1 for the right to buy a company at $11. When I exercise that option and I buy it at $11, even though it's worth 13, I bought it at 11, but I add the dollar I paid to my basis. So my basis is now $12. So if I sold that stock the next day, so let's say I bought it at, I paid $11 plus the dollar of premium, and I sell it the following day for $13 just because I decided I want to exit out. I've held it for less than a year. My basis is $12. So my total taxable gain is 13 minus 12 is $1 of short-term capital gains. That's how that works. It's not horribly complicated, but it is something you'd want to know. Brokerage houses will track that for you nowadays. There's a few little rules you need to be worried about, but we can discuss that at a later time. But this gives you a really good basic understanding of how stocks and options are taxed.